Thanks, Alex. It's a great pleasure to have Rick present today. Rick's an old friend. We were just talking about the fact he showed up in my office back in 2001 when he was working for Scudder Kemper as a consultant. And we talked about the financial software that was out there. But it was surprising, and then the idea that he might start his own financial planning advisory company. And it struck me as very interesting that here was a Ph.D. economist going down this path. I thought that was remarkable and very useful. Rick has a Ph.D. from the University of Chicago, and then he taught at Johns Hopkins University thereafter. Then he spent 15 years doing management consulting in financial services. After that, he went to work for Scudder Kemper. And then in 2002, he started his company, which is Sensible Financial, and started using our software, my company's software. The download version, the early version was called Economic Security Planner, ES Planner. And Rick and his colleagues started using that and continued to do that until we introduced our online software called MaxiFi Planner. Rick joined our board of advisors of the company about 2 years ago, and we've been talking with Sensible Financial very closely about how to improve the software. So many of the things that you have seen come around in terms of improvements have been the direct result of advice that we've received from Rick and his colleagues. He now has 10 financial planners in his company. He started with just one himself, and he's got a really cool company located in Waltham, Mass. Today he's going to talk about when can I retire and what's my number. And Rick, I've asked Rick to tell you a little bit very quickly about his firm, a little more detail about his firm. Some of you may be interested in using his services. Some of you may be financial planners who are thinking about how to best use our software to develop and expand your own companies. So Rick has something to tell, or some of you just may be households, and he may give you some ideas about how best to use our software. That's the whole purpose of these webinars that are continuing. They're all posted at maxifiplanner.com/webinars, and we will have more webinars through the fall and into next year. I think the next webinar will probably be one that I'll give about becoming house rich, or maybe about using retirement accounts to reduce your lifetime taxes. But anyway, Rick, take it away, and thanks so much again for doing this.
Larry, thank you very much for that kind introduction, and good afternoon, everyone. Thank you for joining us. Larry invited me to talk a little bit about Sensible Financial, and I think what I will do is hold that thought until the end, when I'll provide information on how you can contact me if you'd like to. But everyone, I think, on the webinar today is looking to answer the question, or looking to hear what I might have to say about when can I retire and what's my number. And I thought perhaps we would just jump right into that. And today we're going to follow this agenda. We're going to talk about when can I retire, what's my number, with number in quotes, how can I tell if I'm on track, does it matter how long I live, and does it matter when I claim Social Security benefits, and if Social Security benefits are reduced. And as Alex said at the very outset, we're going to do questions or respond to questions at the end of the webinar. But in the interim, if you have questions that are clarifying, that is, if I'm talking and you're not understanding what I'm saying, or you're not understanding a particular chart, please send Alex a question and preface it with the word clarifying in caps. And if several people ask the same question, Alex will interrupt me and I'll do my best to clarify. So, when can I retire? And here's an executive summary of what I'm going to say. You have an implicit retirement plan. That is, you already have a retirement plan, and implicit in that plan is when you can retire. in practice, you can retire once your assets will fund your post-retirement spending, your planned post-retirement spending. Funding a year or several years of retirement requires a calculable amount of assets, and collectively, that's your number. Longer lifespans require later retirement and lower spending, or both. And claiming Social Security benefits at 70 is going to provide you with your earliest feasible retirement because it provides the greatest Social Security resources. So, when can I retire? And superficially, that's a very easy question. You could retire anytime. Just stop working anytime. You might be forced to live in straitened circumstances, but you'd manage somehow. You probably wouldn't be very happy, but that's not the question that most people are looking for, or the answer that most people are looking for. Most people mean that when they ask, when can I retire? When will I have enough income and assets to live the way I want, and or the way I've become accustomed to living? And the way you want to live and the way you become accustomed to living may not necessarily be exactly the same. Personally, I've always wanted to have a sports car, and I don't know that that's ever going to happen. But you want to be able, in thinking about retirement, in our practice, almost everyone that we talk to means when they can continue to live the way they're living. In that question are wrapped up a number of additional implicit questions and worries. And there are two main categories of worries. One of them is that modern retirement lasts a long time, and therefore one has to have enough assets, enough resources to support living a long time. And the second is that the future is unpredictable. And I've listed here three categories of unpredictability that are, I think, primary or top of mind for many people who are thinking about retiring. And those are their investments. The market booms, the market busts, and people are especially worried about the busts. People are concerned about their health and how it will develop. Serious illness can be expensive, and long-term care can be extremely expensive if it lasts a long time. And then there are family issues. And people may not think about those so much when they're thinking about retiring, but after they've retired, they discover that family issues will arise, especially if you have children. Children lose their jobs, children become ill, they get divorced, their children may need extra schooling, may need medical care, and so forth. And many parents, even though they're retired and even though their resources are targeted for their own retirement, may feel compelled to help. Now, I'm going to look those questions squarely in the eye, and I'm going to not address them today because they complicate thinking about retirement. I hope that we'll have an opportunity to think about them another time, but I'm going to think about the easiest question, which is just about resources. But before I do that, I want to suggest one more way, or I want to put a little more flesh on the bones of unpredictability and the fact that 30 years is a long time. And I'm asking you to think back to 1990 and to think back to, at that time, in 1990, how many gurus or savants or whoever you were thinking of as being helpful in planning the future predicted the major events, what I think of as the major events of the last 30 years. 9/11 being one, the rise of the internet and the presence of Amazon and the importance of Google and so forth, the great financial crisis, the fact that we had a black president, President Barack Obama, and then we had Donald Trump. I can't think of anyone, I know of no one, who could do any of those things. And then I ask you to put yourself back 30 years and think about the unexpected events in your own life and think about whether you could have predicted those important financial events at that time. And my strong suspicion is that you couldn't. And therefore, when you're thinking about retirement, it's important to recognize that the future is not predictable, and one has to, in some way, prepare for that. I could spend a lot of time thinking about that unpredictability and talking about that unpredictability, but today I'm going to focus on the easy question. Predictable spending, funding predictable spending, housing, consumption, discretionary expenses, and so forth. How can we tell how many assets are enough to cover those categories of spending? When will we have accumulated them? And I'm not going to discuss investment returns or health shocks or family shocks, because they can distract us from the basic concepts and issues that underlie retirement planning. And introducing those risks and uncertainties too early can really cloud our thinking. So today I'm going to focus on how to understand or how to think about whether you have enough to cover the spending that you can predict. And I'm going to suggest that everyone has an implicit retirement plan. So right now, whether you know it or not, you are on a trajectory to retirement at a date that, if we sat down together, we could figure out. And let me show you how I think about that. Let's think about a world that's really, really simple. And let's abstract from taxes and abstract from Social Security, abstract from the stock market, and let's think about a world in which there are zero interest rates. And right now, there are zero interest rates, so that's not that far-fetched. But the other items are very different from the reality that we live in. But nevertheless, I think that if we take them out for just a moment, it will help us get a sense of the financial planning problem. So let's think about two men, Bob and Charlie. They're both 55. They both earn $100,000 a year. And they're going to be the basis of our thought experiment. Charlie spends $60,000 a year, and he has $1.25 million in savings. And Bob spends less than that, substantially less than that, about $46,000 or $47,000 a year, and he has savings of $1.65 million. And I'm going to ask you, we're going to have a little poll here, who is the better saver, Charlie or Bob? So I'm going to ask Alex to conduct our poll. It says the poll is open, and while we're waiting, I'll just say a little bit more about this question. This is very similar to a question that I ask job candidates, people that want to work at Sensible Financial, because I want to understand how they think about retirement. And often, candidates will ask me questions before they answer my question. They'll ask me things like, well, in order to be able to tell me whether one or the other is a better saver, they need to know when they're going to retire and how much they want to spend in retirement. And if you are an experienced user of MaxiFi, you may recognize that those questions are not necessary. Answers to those questions are not necessary to know who is the better saver. But we'll find out what everyone thinks in just a moment.
Okay, I think most people have voted here, so we're going to close the poll and we'll show the results.
All right.
Okay.
You're sharing the results, but unfortunately, Alex, I cannot see them.
Okay. So here are the poll results. The winner is not enough information to say. It's 50%. 7% says they are equally good. 17% is Charlie, and the second best here is Bob at 27%.
Aha. Okay. Well, now the big reveal. And before we get the big reveal, let's look at the numbers here. So we're showing Charlie in blue and Bob in orange, and the snapshot said, if you remember, that Bob had more savings and that Bob was spending less. And we're showing, I should tell you what we're looking at on the chart here. These are the ages down here. So Bob and Charlie are both 55. And both Bob and Charlie are earning $100,000 a year. Charlie is spending $60,000, and Bob is spending a little less than $50,000. And now let's see, and you notice that Bob's assets are higher than Charlie's at this point. But if we think about their plans, we can see that Bob is planning to retire at 60, and he's right on track for that. His assets will reach the level of assets that he needs. He's planning to live to be 100, and he'll be right there. He'll be right at the level of assets he needs to retire at 60 if he just keeps doing what he's doing. Charlie is planning to retire at 70, and he is right on track for that as well. Even though he's spending more, and even though his assets now are lower, by the time he reaches 70, he'll have exactly the amount of assets he needs to sustain that spending level of $60,000 for the rest of his life. So both of them are good savers, and both are right on plan. So I think that if you answered they were equally good, you got it right. And if you said there's not enough information to know, that's fair. There probably wasn't enough information to know. But the fundamental point here is that both of them were on a trajectory, and we could get a sense of that trajectory by looking at how much they were spending, how much they were saving, and what their assets were. And we know that just by looking at the chart, that if Charlie had come to us at 55 and said, I want to retire at 60 and I want to keep spending $60,000 a year, he would not have been able to do it, because I can extend this line up here. If you'd let me, I'd extend it up here, and I'd say if he wanted to retire at 60, he'd need a good deal more assets than Bob will need, because Charlie's planning to spend more, and he's got less assets than Bob has or will have. So Charlie couldn't retire at 60 if he asked us if he could afford to, we would say no. Now let's meet the y'alls, who are the people that we're going to use as our examples throughout the rest of the webinar. And Tina and Steve Y'all are both 55, just like Charlie and Bob, but the resemblance ends there. Tina's a therapist. Steve is a personal trainer. Tina earns a little more than $82,000 a year. Steve earns about 41, and together they make almost 125,000. They have 401k assets together of about 226,000 and other savings of about 225,000. And they have both been saving, or not saving, but because their income has been reported, they've been paying Social Security taxes, and their Social Security earnings records are going to be important in determining how much Social Security income they have available to them. And it turns out that, in fact, I constructed it this way, that Tina has earned 60% of the Social Security's wage base since 1987, when she started working, and Steve has been earning 30% of that wage base since 1987. And let me say that any resemblance to any person, living or dead, is completely coincidental, and I've constructed the example to illustrate aspects of the basic retirement decision. And I'll state that the Social Security wage base is the maximum level of earnings on which FICA taxes are paid. And this year, that's $137,700. Now, what else is going on in this world? This world is very much like the world that we live in. We've made assumptions, however, about what will happen to Social Security benefits and taxes, and we're assuming that benefits and taxes will change in 2035, that benefits will be reduced by 11% at that point, and that taxes, FICA taxes, will increase by 12%, from 12.4% of earnings to 13.8% of earnings. And this assumption allocates half of the solvency restoration cost, because if you read the report of the trustees on Social Security, they indicate that the Social Security Trust Fund will become empty around 2035, and at that point, if nothing is done, benefits will have to decline because taxes will be insufficient to fund Social Security payments, benefit payments at that point. And the trustees themselves provide these estimates. So we're using those estimates, and I believe that that's reasonable, because historically Congress has split the difference when it's had to make changes like this or respond to issues like this, and this would impose half the cost on those receiving benefits and half the cost on those paying taxes. That has a certain political attractiveness, I suppose. I've assumed that life insurance will not be purchased by either Steve or Tina after the age of 70. That's a simplifying assumption, and I've checked, and I'm pretty confident that it is not an assumption that actually has any impact, because in none of the scenarios that we're going to look at would either of them have needed life insurance. And I'm using a nominal rate of return of almost 2.8%, and a forecast inflation rate of 2.1%, and a real rate of return of 0.6%. Sensible Financial adjusts our assumptions once a year in January, and these were the numbers that we developed at that time. I know that if you've been watching other webinars or receiving emails from Larry, you'll know that these differ a bit from the assumptions that he recommends. We have to balance in our practice the currency of the figures that we're using with consistency across plans in a calendar year, and we're erring right now on the side of being consistent across all the plans that we developed this year. All right, so when can the y'alls retire? And we're going to now ask MaxiFi the answer to that question. And I'm going to use as a device here a way of presenting the scenarios we're going to look at. We'll use this a little bit later on when we have more complicated scenarios as well. But the scenarios are very simple. Retire now at 55, retire soon at 60, retire what I'm calling average at 65, or work until Social Security benefits start at 70. And remember, we assume, I guess I didn't note this, but the y'all strategy is to start benefits at 70. And the answer is they can retire at 65. And I thought that I had said earlier that y'all spend $38,000 a year on consumption. I hope I said that, but that's the amount that they spend. Let's just look at the diagram for a moment. So on the vertical axis, we have the sustainable consumption, or what MaxiFi calls discretionary spending, and this is in thousands of dollars. And then we have the four scenarios here: retire at 55, retire at 60, retire at 65, and work until 70 and then retire. And then the vertical bars, say 17,000 or 27,000 or 38,000 or 49,000, tell us what the y'alls could spend every year on discretionary spending for the rest of their lives if they retire at 55, 60, and so forth. And since they currently spend 38,000, and they could spend 38,000 on discretionary spending if they retire at 65, 65 is when they can retire. The pinkish boxes here show you the difference between each scenario. So between 17,000 and 27,000 is 11,000. We're rounding here, so I imagine that the 17 is less than 17 and a half, and the 27 is a little bit more than 27, so that the difference is 11. But the difference is, for each 5 years that they work, they can get about $10,000 a year more in discretionary spending. And I'm not going to show you underlying details in the MaxiFi output. We'll look at some of them in some of the later scenarios, but because they'll help illuminate what's going on in those scenarios. But let's spend a little bit more time now. Let's move on to talking about the number, and then we'll come back to some of the specifics here. In 2006, Lee Eisenberg wrote a book called The Number. You can still find this on Amazon. It was a New York Times bestseller. It was a Wall Street Journal and a Business Week and a USA Today bestseller. It's been published internationally. And it's a very interesting book. It's not just about asset accumulation, despite the title. And he has thoughtful things to say about thinking through your priorities and so forth. But when he was starting to think about the number, he was thinking about how much net worth people needed in order to retire. And he spent a lot of time in the book talking to a lot of different people and asking them what their numbers were. And he found that people that worked on Wall Street all had an idea of what their numbers were, and nobody else really knew. That's I'll save you a little time if you want to just get the gist. But nevertheless, the number as an idea is kind of compelling. You'd like to know how much you need in terms of assets in order to be able to retire. And the short answer is there is no single number. There's a number for each year that you might choose to retire. And if you're planning to retire earlier, you have to cover more spending years. And if you're thinking about living at a particular living standard, the earlier you're planning to retire, the larger the number will be. Alternatively, if you say, well, I've picked a number and I'm going to, and suppose it's $1 million, and you're going to retire, you're thinking maybe you'll retire at 55 and maybe you'll retire at 60 with the same $1 million. If you're going to retire earlier with the same $1 million, your living standard in retirement will be lower. Let's explore that a little bit more. So let's go back to the alls. And remember that just a couple slides ago, we said that without any extra assets, if they retired at 55, they could spend $17,000 a year from that day forward. At 60, they could spend $27,000 a year from that day forward. At 65, $38,000, and at 70, $48,000. We can allow them, we can help them retire earlier with spending at 38,000 if we give them more assets. And MaxiFi is terrific for this. It makes it really easy to construct scenarios. And so I just gave them more assets and figured out how much more I would have to give them in order to allow them to retire at the particular age that we're looking at. So if they wanted to retire at 55, if we gave them $925,000, then they'd be able to spend $38,000. If they wanted to retire at 60, we'd have to give them $450,000. At 65, we don't have to give them anything extra. And at 70, since they, if you remember, could spend $48,000 if they retired at 70, we could actually take some assets away. We could take $450,000 away, and they could still spend $38,000. They have extra. So now this is not quite the number, right? Because the number is the amount of assets that they need to have at the retirement age. And these are numbers, these are extra assets that we're giving them at 55. So let's see what we can see about the number. And as we do that, let's develop a little bit of intuition about how much more they need. We just saw that they need $450,000 more assets at 55 if they want to retire at 60 instead of at 65. Right? Here, they need $450,000 more. Remember also that they could spend, they were $11,000 short. They could spend $27,000 instead of the $38,000 that they'd like to spend if they retire at 60 without the $450,000. So they need $11,000 a year for 45 years, and if we just multiply that out, 45 times 11,000, we get 495,000, which is pretty close to the 450,000. And I'll tell you why it's not exactly the same. The reason it's not exactly the same is that our real interest rate is slightly positive, and they're going to earn returns on that 450,000 and the assets that they have extra. Relative to the situation where they don't have the 450,000, that's going to add up to enough to cover the 11,000. And I like to get a sense of, or I like to develop some intuition because I'd like some confirmation that the numbers are right. And I'm not worried that MaxiFi is going to calculate incorrectly. I'm worried that we're going to put the numbers in incorrectly. We're going to put in incorrect data. And so I like to have a sense that we've done it right. And here we have a sense that we've done it right. But when you're working with MaxiFi and you make a change in an input and you get a change in the output, it's useful to think through why you're getting the change in the output and whether it is what you would expect. And here we're getting pretty much what we would expect. So what difference is there in the number now? So what assets do the y'alls need if they're going to retire at these various ages and be able to spend $38,000 a year? And I'm showing you two things here. I'm showing you, first of all, the 401k assets that we're expecting that they'll have when they retire. And then I'm showing you the taxable or brokerage assets that I'm expecting that they'll have when they retire. And then on the left here in the little boxes, I've put the amount of the total amount of brokerage assets that we expected them to have, or that we gave them at 55 when we did that little example just a moment ago, or when we figured out how much extra assets to give them just a moment ago. So their number at 55 is $1,443,000 to spend $38,000 a year for the rest of their lives. At 60, it's $1,134,000. At 65, it's $821,000. And at 70, it's $496,000. So as I indicated, the number gets smaller the later they're planning to retire, or the later they're willing to retire. Now you could say, well, where are they going to get this extra money? And there are potential sources. Some people inherit assets that might allow them to retire earlier. Some people invest in the stock market hoping for a greater than risk-free return, and they may get assets that grow more rapidly than the risk-free return would allow. Some have generous relatives. I'd like to have generous relatives like that. But it's helpful to know the number even if you think it's unlikely that you're going to reach it. Just to have a sense of ultimately what assets you will need when you do get to the point when you're ready to retire. All right, now let's think a little bit more about this number. your retirement assets have to cover total spending. And for the y'alls, that is their discretionary spending of $38,000. I've had them be renters, and so they're spending $30,000 a year on rent. They're going to spend $1,800 on average on income taxes while they're retired, and their Medicare Part B premiums are almost $9,000. So if we add that all together, we get $78,600. That's the amount that they have to cover. So let's have a little bit more intuition about that. Let's develop some. So we see here on the left, $79,000 to $78,600 that is their total spending once they retire, and then we've also shown their Social Security income, which I've projected and which MaxiFi has projected to be $61,000. So if we start with their Social Security income will cover a good fraction of what they need to cover their full spending. If they retire at 70, this is conceptually what their number is. It has to cover the gap between Social Security income and total spending. And if we're being precise here, this isn't quite right because we'd have the assets at age 70. We might hope for some income on those assets, and that would mean that we could have a little bit less than this, or maybe a lot less if the risk-free rate was large. Now, suppose that they're going to retire at 65. They need the amount that they needed at 70, and they have to cover all of their spending between 65 and 70. And if they're going to retire at 55, they need the number at 65 plus enough to cover all of this spending from 55 to 65. So this conceptually shows you that the number at 70, which is here, is smaller than the number at 65, which is much smaller than the number at 55, which is the entire non-green space. All right, so now, how can we tell if we're on track? MaxiFi is terrific for this. So, and I'm going to talk about two ways that you can do this. One is you can run a MaxiFi plan every year and use your current information about income and assets and your Social Security history, your plans for retirement, your plans for housing, education, other fixed expenses, and reasonable assumptions for taxes, rates of return, inflation, and so forth. Or maybe you ran MaxiFi 5 years ago and you don't want to run it again. You can still review your asset growth each year against the prior plan. Either of those works to give you a sense of whether you're on track. If we're running the plan every year, you need to do two things. You need to look at your sustainable or the annual discretionary spending or level discretionary spending or smooth discretionary spending that MaxiFi reports that you can afford, and that should be about what you're spending, more or less. And if you're spending less than the sustainable amount or the smoothed amount, then that gives you some cushion. And with the prior plan, if you did the plan 5 years ago, you should adjust your assets for inflation back to the dollars of the plan year, and then check to see if your asset growth is matching the plan, more or less. And if it is, then you're on plan. And if we think back to the y'alls for a minute, if the y'alls were planning to retire at 65, they were on track. But if they want to retire now, they're not on track. And if they want to retire at 70, they're ahead of plan. Okay? And if we think about, if instead are looking back at a plan that we did 5 years ago, then we would look at the forecast, or not the forecast, but the planned growth of assets. This is a chart directly from MaxiFi. And you have to adjust for inflation because we're running, MaxiFi generally runs in inflation-adjusted dollars, and especially if you're looking back 5 years or more, it's unlikely that you forecast inflation correctly. But you can check your asset growth against the asset growth that was projected or planned, and if you're more or less around the amount that was projected, you're on track. If you like to use numbers instead of graphs, MaxiFi produces a table too. All right, moving on to the next question. Does it matter how long I live? We're going to look at what's the impact of a shorter lifespan. And now we're going to look at two parameters here as we do scenarios. We're going to look at one where we vary retirement age, and the second where we vary lifespan. And we're going to look at 4 scenarios. One where we retire at 65 with a full lifespan. We're using 100 as a lifespan. Second, where you retire at 65 using 90 as the lifespan. And notice that the shading orange here tells you that we're changing this parameter between these two scenarios. We're not changing this parameter between these two scenarios. And then as we move to the third scenario, again, we're keeping the lifespan at 90, and now we're taking the retirement age back a year. And for scenario 4, we're taking it back still another year. And let's see what happens. For the Y'alls, remember we said they could retire at 65. If we change their lifespan to 90, so they're expecting to die younger, then if they retire at 65, instead of spending $38,000, they could spend $43,000. If they retire at 64, they could spend $40,000, which is still more than $38,000. And if they retire at 63, they could spend $37,000, pretty close. So strictly on the numbers now, and without all the risks that we talked about, they could retire 1 or 2 years earlier with a lifespan 10 years shorter. That's a pretty small impact. Now, why is that? So if Social Security is your sole resource, longevity is irrelevant. How long you live is irrelevant, because your Social Security income exactly matches your spending, and taking 10 years off your life doesn't change the amount that you need at all. On the other hand, if you've got larger assets and Social Security is relatively less important, then you get a larger impact on your lifespan. So here, and these numbers are not going to match anything else that we talk about today, but I reran the plan for the Y'alls, giving them $1 million more at 55, and then they can spend more. They can spend $61,000 a year, and you see that as we move to a shorter lifespan, and they can spend a good deal more, and changing the retirement date by 1 year doesn't have that much of an impact on how much they can afford to spend. So here they can retire at 61 and still spend the same amount that they're spending with the extra assets with the shorter lifespan. So just to try one more time with intuition, if we think about the situation where let's say they're going to retire at 55, these retirement assets have to cover all of this area, right? And if we shorten their lifespan from 100 to 90, then we get this amount available to spend on retirement. And you can see that we're not going to be able to get much benefit out of that because it's small relative to the amount that we have to cover here. If we have much higher assets and much higher spending relative to Social Security income, then shortening the lifespan gives us a lot more assets that will allow us to retire a good deal earlier. And in fact, if you push it to the extreme and you said, suppose there's no Social Security income, then each year of shorter life allows you to retire a whole year earlier. However, we really discourage people from reducing their lifespan in MaxiFi to make your plan work, to allow you to retire when you want to retire. People make a lot of mistakes when they think about how long they're going to live. First of all, when they hear life expectancy, they think that's how long they're going to live. But the life expectancy is the mean of the probability distribution, not the maximum. So if somebody tells you that your life expectancy is 90, if we could run your life 100 times, 50 times out of 100, you'd live past 90. 50 out of 100, you'd live less than 90, but 50 out of 100, you'd live beyond 90. And if you're planning using MaxiFi, and if you are not annuitizing all your assets so that your income lasts as long as you live, then you have to fund those years up to your full lifespan. You have to plan to fund those years. So getting the lifespan correct is very important. In addition to not fully understanding life expectancy, people tend to underestimate how long they're going to live. I guess that's just the way we are. People also tend to base their judgments about longevity on their family experience. So how long their mother lived, or their father lived, or aunt or uncle or grandfather. It's important to understand that longevity has been increasing, and increasing pretty significantly. So judgments that you make based on your family experience are again likely to be biased down. And finally, if you guess short, suppose you set your lifespan, I joke about this a little bit. I say, if I set your lifespan at 85 and you spend that way, and then you come see me at 85 and you say, well, we spent the money, now what do we do? There's really nothing to do. It's very difficult to add resources after you retire. And it's extremely difficult to add resources once you're in your 80s. All right, so now on to Social Security claiming. So y'all can retire at 60 if they claim benefits at 70, but not if they claim at 62. Remember that to allow the y'alls to retire at 60 and have them claim at 70, we gave them $450,000. If we have them claim at 62, they give up $380,000 in present value of Social Security retirement benefits. That's almost the same as the $450,000 that we gave them. So you can imagine that it's not going to be pretty. It's not near enough to allow them to spend $38,000 if they claim at 62. And I'll work through that a little bit more here. So remember that they needed this. The y'alls needed the $1,134,000 at 60. And now we're going to expand the balance sheet a little bit. And MaxiFi is, again, very good at this. And we're going to look at the value of Social Security benefits if they plan to claim at 70 for the y'alls at 55. So at 55, the present value of their future earnings is $730,000. The present value of their Social Security benefits is $1.5 million. Their retirement accounts the present value of the assets they'll accumulate and then draw out is $276,000, and their regular assets are $693,000. Right? Remember, we gave them extra assets. Importantly, though, the Social Security benefits are half, or almost half, of the total. Now, suppose that they claim at 62 instead of at 70. These numbers, the labor earnings, the retirement account withdrawals, and the regular assets, none of those change. But the Social Security benefits are down very significantly. It's $380,000 less. So let's look at their situation as we think about two changes that we've made. So first of all, let's think about the situation that we put them in at the very outset, where we said they had $225,000 in 401k assets, $225,000 in brokerage assets, and we didn't show it before until the lifetime balance sheet, about $1.5 million in Social Security asset or benefits, present value. That allowed them to spend $27,000 a year. And we gave them another $450,000, that would allow them to spend $38,000. But now, if they retire at 62, that Social Security asset, instead of being worth $1.5 million, is worth only $1,160,000. And therefore, if they claim at 62, you see it's $1,160,000 in both cases. If they retire at 60 without the extra brokerage assets and with claiming at 62, they can only spend $18,000. If we gave them $450,000, then they could spend $29,000. But if they want to spend $38,000 and retire at 65, they've got to claim at 70 to get these large, or to get this large present value of benefits. Claiming Social Security early is really expensive if you look at it from this perspective. Okay, so our last point now, our last question now. What about if Social Security benefits are not reduced? What difference will that make? I know I asked the question the other way, at the outset, at the very beginning on the agenda, and I think that's because I think I've done it this way because I believe it's quite likely that benefits will be reduced, and I think it would be it's safer to assume that they will be. But let's see what the impact is. If we think about what's going on with Social Security, under current law, Social Security is projected to be $12.5 trillion short over the next 75 years. And fixing Social Security requires increasing taxes, reducing benefits, or both. And as I said, we're assuming both. Starting in 2035, the benefits decrease by 11.5%. Payroll taxes increase from 12.4% to 14.2%. Now, for the y'alls, the impact is all going to be on benefits because they're going to be retired by 2035. So if instead of the benefits reduction that we're assuming, which give them $1,540,000, they got their promised benefits, which is $1,730,000. At 65, they'd be able to spend $43,000. So they could retire at 63 if they got their full benefits and they knew they were going to get their full benefits. Then they could retire a little bit earlier. The full benefits relative to our assumption adds about $190,000 to their Social Security wealth. Just as with shorter lifespan, where we saw that if Social Security benefits were large relative to your plan, or the size of Social Security benefits relative to total assets had a big influence on how much impact shortening your lifespan had, the same is true here. The more important Social Security is to your plan, the greater the impact of benefit reduction on when you can retire, forcing you to retire a little bit later. And then I just emphasize that we're financial advisors, we're not political scientists. We can make our best forecast, and that forecast for us says you can rely on Social Security benefits, but we don't recommend that you assume that there will not be any benefit changes. I think that's an assumption that's a little bit too favorable. So we've reached the end of our discussion here. So let me just review what we've seen and what we've said. You have an implicit retirement plan, so the saving you're doing and the spending you're doing has implications for when you might plan to retire. And I guess I would say if your implicit plan is inconsistent with the plan you hope you have, you can use MaxiFi to find that out, and the earlier you do it, the better, because the adjustment that's required will be less. the sooner you find that out. In order for you to retire in the way that you would like to, in the style to which you are accustomed, your assets have to fund the post-retirement spending that you plan. And MaxiFi calculates that for you. MaxiFi is terrific at that. Each additional year that you want to be retired, so each additional year that you want to retire earlier, you need more. Your number is larger. And adding retirement years before Social Security benefits kick in, those retirement years are more expensive than retirement years after Social Security benefits kick in. There's more to fund. And positive rates of return reduce later year funding costs, or alternatively, zero rates of return increase later year funding costs. Right now is a very expensive time to be thinking about planning retirement, unfortunately. Longer lifespans imply later retirement and lower spending, or both. And I just emphasize that we recommend that you be extremely cautious about planning for a short lifespan, because making that mistake, planning for a shorter lifespan than you actually get, may put you in a situation where you're really short of resources later in your life when you can't do much about it. You're on track if your sustainable living standard is at or below the sustainable discretionary spending, the spending that MaxiFi tells you can afford every year. Alternatively, if you're looking back at a previous plan, your spending is where you planned it to be, and your assets are at or above where you planned them to be, where MaxiFi projected they should be. And finally, claiming Social Security benefits at 70 supports your earliest feasible retirement. But right now, with interest rates the way they are, especially, but also the way Social Security benefits are calculated, each additional year that you wait, each additional year that you wait adds substantially to your Social Security wealth and allows you to retire earlier. The one exception to that is if you know that your lifespan is going to be very short or shorter than the average, let's say, and you don't have anyone depending on you, that is anyone whose benefits will depend on your benefits, then you may wish to draw your benefits earlier, claim earlier. And I know Larry would want me to say that Maximize My Social Security, that piece of software can be helpful in thinking that through. And finally, if you know your Social Security benefits will not be reduced, how you would know that, I'm not sure. But if you do, then you can retire a bit earlier. Okay, so if you want to get in touch with me, my email is here. Sensible Financial's website is here, and here's my Twitter link and LinkedIn. I'll caution you that I'm not the most social media active person. You're going to have better luck if you send me an email than if you try to reach me on Twitter or LinkedIn. And I think we'll leave it there. Alex?